So this next step, it happens, you might consider this a little bit out of order, but because really when we're doing the balance sheet, we can take it even better straight from the post-closing balance. But as long as we have our adjusted trial balance, then we have the profitability of the company over time. So the income statement's all about profitability, and it has all of our nominal accounts except dividends. Remember that dividends are not on the income statement. We can take all of these nominal accounts, and remember the nominal accounts are grouped. The nominal accounts that relate to income are all together here. Dividends is not included in that, as I just stated. And that is always our last one. But we can take these and basically cut and paste, and we have a very simple form income statement, one that we'll add some bells and whistles to when we study the income statement by itself. But then once we have the income statement, we can move into calculating the statement of stockholders' equity, or like I said, sometimes we're calling it in this class the statement of retained earnings, because stockholders' equity looks at both direct and indirect investments. Really, in our class, we're focusing on that indirect investment. Remember that retained earnings at the end of any period is equal to retained earnings at the beginning of that period plus net income minus dividends. And because we're going to ignore those direct investments more or less in this class, after you have that income statement, you can go ahead and figure out how equity has changed over time, because you have the beginning retained earnings in your unadjusted trial balance or your adjusted trial balance. It's 250 in either place, right? It hasn't changed because we don't make adjustments to retained earnings. Then you can add in any income from the work you did in the adjusted trial balance, and then subtract off those dividends, and then you get ending retained earnings. So then you can solve for, well, what is equity? We go to the balance sheet. Now the balance sheet is about capital structure and risk of a company at a moment in time, right? The equity just tells me how ownership might have shifted over time. That feeds into the balance sheet. And then finally, we get the statement of cash flows, any cash-driven activities from the firm that are segmented into operating activities, investing activities, and financing activities. We prepare those statements, and then finally we record in post-closing entries. When we're doing this, what we're doing is reducing all nominal accounts to zero. Remember, our nominal accounts are all income statement accounts, those are our revenues, expenses, gains, and losses, and then plus the dividends account. So we're going to close all 5 of those types of accounts. We close them through I made a little bit of a generalization. Reduce not all nominal accounts, because that would include dividends. Reduce all nominal, and I will insert, and you should insert the words income statement accounts to zero by closing them through what we call an income summary. Okay. That is so that we can calculate in a very literal bookkeeping journal driven sense net income. And then we close the income summary to retained earnings. So really, what we're doing with closing entries is providing evidence for the calculation of net income and retained earnings and forcing it into our record keeping process by journalizing it, posting it to the ledger, and then creating finally the post-closing trial balance. So the step-by-step process is we close out all revenue accounts, and we should list individual revenue accounts in practice. Now, on an exam, you might be taxed for time. You might want to group them all together. Just remember that I can only grade the information you give me. So if you have just a totally incorrect number for revenues and it combines, say, 3 or 4 revenue accounts into one incorrect number, but maybe just one of those 4 was incorrect. If you don't show me your work, I count the whole thing wrong. If you show me your work, I'll give you partial credit because you got 3 of the 4 correct. Even more appropriate to expense accounts, because generally speaking, we'll have more expense accounts individually being closed out. So again, make sure you show me at least enough so that I know to give you some partial and not just count the whole thing wrong. So we close these individual guys out into the income summary. Then once we have the income summary account reconciled, we close the income statement account, the income summary account out, whatever balance it has. We close that to retained earnings. The first part is just mimicking, all right, we take my revenues, we subtract my expenses, we add my gains, we subtract my losses, and that gives me net income. So that's what we're journalizing and posting when we do the first 2 pieces of that. We're creating that net income number, and that net income number is the balance of the income summary. The next part, when we're closing out the income summary to retained earnings, what we're doing then is taking beginning retained earnings, because that's already in the account, and we're closing out the income summary. So we're adding in this piece. So this actually is step number 3. Closing out the income summary to retained earnings adds in net income to my beginning retained earnings. Now, closing out the dividend account performs the 4th step down here by reducing retained earnings by any dividends that were declared during the period. Notice I said declared, and that will be important. Now, I'm going to recreate the trial balance that I just had, that I just took from step 5, and put it here so that we can just more easily start to create these entries. We had 2 revenue accounts. I split them up. We had the sales revenue that was unadjusted. We had the adjustment to that when we recorded some deferred revenue. So in order to close out those accounts, I would want to debit the revenue accounts. This is one of those very limited times that you will debit rather than credit a revenue account. And I will shorthand. I don't mind you shorthanding on tests. The only time that I want you to be very formal is on that practice problem. And now I'm going to credit both of these to the income summary account. Just a real brief, I'm not going to go through them all this way, but just to sort of jog your memory, like, well, why am I debiting revenue again? Remember that since sales revenue here, I'll just take that one account. Since sales revenue is a credit balanced account, right? It started, all revenue, all nominal accounts start our period, their beginning balance is 0. Well, during the period, I added $300,000 to this. This was not an adjusting entry. That was there on my unadjusted trial balance. So then in order to close it, I want to debit it by $300,000, which will close it out and give me a $0 balance going into the next period. That's why we apply the debit. And this is a rare event when we debit a revenue account. Like I said, most of the time, we're going to credit those accounts. So that gives me step 1. Now I also have an income summary account that I've just created that I'll start keeping track of here. The income summary, remember, is just a representation of net income for the period. It starts at 0 because it's also one that we just create and then close out. We don't want last year's net income to influence this year's income, or this year's income to influence next year's income, so it has to be closed out. But here we're crediting it for all of the revenues we just closed out. Now we're going to turn to my expense accounts and close each of those out separately. Now, just like the revenue, except opposite. We have, for example, the rent expense. Rent expense also is a nominal account. It starts the period at a $0 balance, but then during the period, we debited it for $20,000 because we had to pay rent for the year. Well, in order to close that, I'm going to want to credit it, which again, for expense, it's very rare for us to credit expenses, but this is one of those times that we will, because now that will return the account to zero as we close it out. So I'm going to do that to each of my individual expenses. I have rent expense. I have salary expense. I have amortization expense. I have depreciation expense, and I hope I don't run out of room. I might. I have interest expense. I'm going to have to get smaller. I have insurance expense, not going to make it. But I have another piece of paper under here, so we're going to use that. And I have tax expense. So all of those guys get closed out. Let's go ahead and do their amounts. $20,000 for rent expense, $55,000 for salary, $4,000 for amortization, $21,667 for depreciation, $6,000 for interest, $10,000 for insurance, and $41,667 for tax expense. Now I'm going to add all those up again in real time. So bear with me for a second. 20 plus 55 for 21,667, 6, 10, 41,667. Gives me 158,344. Before I write it, I want to double check it. So I'll write it here. Well, actually, I will write it. You'll be using a pencil, so you can always erase. Always double check your math. Now I'm going to go backwards by subtracting 41,667, subtract 10, subtract 6, subtract 21,667, subtract 4, and yep, that is correct. I close all this out to the income summary. $158,334. Now I balance and reconcile this account. I take the $325,000, subtract off the amount I just calculated, and that gives me the new balance for the income summary account, $166,666. Remember that this is my net income for the period. Also, something to note that sometimes for some reason people leave off is they leave off this tax expense from their closing of the expenses. It has to be included in there because, again, remember we're calculating net income. And if we use the term net income is after taxes. So you have to make sure that is net of taxes as well. The next piece is closing out the income summary account. And now we know how to do that because we have its balance. We want to debit it by 100,666. Well, in order to make that happen in this ledger account, I have to provide a journal entry, debit income summary for $166,666. And the credit, remember, we're closing this out to retained earnings because net income affects retained earnings. So the result is an increase, a credit to my retained earnings. Retained earnings is an equity account. We increase equity accounts with credits. So we are increasing this equity account, and that makes sense because we had net income for the period. We had net income for the period. because our revenues were greater than our expenses. Notice that on the income summary, revenues end up being credits to the income summary. Expenses, as we close them, end up being debits to the income summary. So if we have a credit balance, we have net income. Now, you could imagine that if the company was not profitable, the situation would have been reversed. We would have had if we had, say, $100,000 of revenue and the same amount of expenses, we would have had a $58,000 debit balance in our income summary, and that would have represented a loss. Well, when we closed that loss to retained earnings, we would no longer credit retained earnings, because if we had a $58,334 debit balance here, we would have to credit the income summary for that amount to close it, and then we would be debiting the retained earnings instead of crediting retained earnings. But now we've closed out income summary. There's just one more item that we have to do, and we have to close out that dividends account. And dividends is a debit-based account like expenses are. Remember, dividends are the very same thing as expenses, except that it's a distribution to the owners. It reduces our equity in the company, but because we're paying out to owners. So dividends is a nominal account. It starts at a $0 balance. It has been debited by $10,000 during the period. Therefore, we got to close it out with a credit, and that will zero out my dividends account. But I need to get that $10,000 in there by a journal entry. So I'm crediting dividends, and I'm going to echo that by debiting retained earnings. And poor journal entry form, I ran out of space. If I had a pencil, I could have done that better. All right. So now we have all our stuff to retained earnings. Well, one final thing I want to leave you with, and I had some room on the next page for you. I apologize for not flagging that. You were probably cramping all that in there with me. Is the retained earnings. So what's happened to that account? Because this is going to allow us to know what the ending balance of the retained earnings account is. Well, let's remember, it's very common for folks to forget retained earnings has a balance in it to begin with. It has a $250,000 balance on our adjusted trial balance. So that's where we're starting from. It is not a nominal account. It carries forward. Well, we had two entries to retained earnings that affected it. We increased it by $166,666. That's my net income piece. And then we closed out dividends and reduced it by $10,000. Which creates during the year, or after I add the 166,666 to 250, subtract the 10,000, at the end of the year, I'm left with $406,667 of retained earnings. That's my 12/31 post-closing balance. And now let's take a look at the result of that. After we've done all these closing entries, updated our ledger accounts, after we've made those closing entries, updated the retained earnings account, right? We now are left with the following final post-closing balance. We have everything that was on the adjusted balance. What's changed? We no longer have, if we go back to that, we no longer have any of these nominal accounts. Sales revenue, revenues, expenses, dividends are all gone. Where have they gone to? They've all been collapsed into retained earnings. So the only things that change between an adjusted trial balance and a post-closing balance is the retained earnings and all of these small nominal accounts that have been closed out now. So we see our adjusted retained earnings that has now been updated to the end of the year, and there is a discrepancy in the totals simply because there's rounding error. that was involved in there, and that's fine. It's not a big deal. But yeah, that's the whole process. And then we start it all over again at the beginning of the new period.